Welcome to BigONE Weekly News Update. I'm Mia. The crypto market suffered one of its most violent sell-offs of the current cycle last week as a disorderly wave of forced deleveraging swept through both digital and traditional markets. Bitcoin briefly plunged to $60,000, posting a single-day decline even larger than during the 2022 FTX collapse, before rebounding sharply. Despite the recovery, BTC still fell 9.5% for the week, closing near $70,280. Ethereum declined 7.9% to around $2,090, while Solana dropped 14% to roughly $87. Global markets diverge as volatility surges. Crypto turmoil unfolded alongside heightened volatility and sharp divergence across global markets. Fears of AI-driven disruption triggered concentrated selling in momentum-heavy software and technology stocks, while earnings season surprises added further instability. The Nasdaq fell 1.84% for the week and the S&P 500 edged lower, while the Dow Jones rose 2.5% on strength in small-cap stocks. European equities advanced modestly, U.S. Treasuries rallied, and gold jumped more than 5%, reflecting a shift toward defensive positioning. A rare and severe Bitcoin drawdown. From mid-January to early February, Bitcoin fell for 3 consecutive weeks, dropping from above $90,000 to the low $60,000s, an average weekly decline of roughly $10,000. At its trough, BTC was down more than 50% from recent highs, placing the move among the most severe drawdowns of this cycle. What stood out was the intensity of activity. Despite a near 50% decline in Bitcoin options notional value since October 2025, February 5th ranked among the most active options trading days on record. On the same day, BlackRock's IBIT ETF recorded over $10 billion in single-day turnover, while IBT options hit their highest volume since launch. Hedge fund losses spark mechanical selling. The February 5th sell-off followed one of the worst days on record for multi-strategy hedge funds, with losses equivalent to a 3.5 standard deviation event. Such drawdowns typically trigger strict risk controls, forcing funds to rapidly reduce leverage across strategies. This indiscriminate deleveraging ignited the sharp crypto sell-off, with Bitcoin dropping more than 13% in a single day. Several highly leveraged on-chain positions were also forced to unwind, pushing Bitcoin's implied volatility to 75%, the highest since spot ETFs launched in 2024. ETF stability masks structural stress. Despite the price collapse, IBIT did not see net outflows during the sell-off, instead recording net inflows on both Thursday and Friday. Meanwhile, the 30-day CME basis surged sharply, signaling forced liquidations among traditional funds engaged in basis trades. As volatility spiked, these trades unwound mechanically, compelling market makers to sell aggressively for hedging purposes and reinforcing downside momentum. These flows were largely disconnected from Bitcoin's fundamentals and driven by risk management constraints. Traditional finance is amplifying crypto volatility. This episode underscores how deeply Bitcoin is now embedded within the traditional financial system, spanning spot markets, futures, ETFs, options, and structured products. As a result, leverage from traditional finance increasingly amplifies crypto volatility. Because Bitcoin trades around the clock, margin stress in global markets often surfaces first in BTC prices. Entering a high-risk, deep-water phase. Historically, once Bitcoin drawdowns reach the 50 to 55% range, market certainty fades. The initial decline tends to follow a straightforward risk-off narrative, but beyond this point, price action becomes increasingly chaotic and psychology-driven. With volatility elevated and leverage still unwinding, the near-term outlook remains unstable. Markets are no longer trading on conviction, but on stress, making this phase particularly challenging for positioning and risk management. Join BigONE today and take advantage of the growing cryptocurrency market.